Hello, and welcome to another episode of Accounting Insiders. My name is Gary DeHart. I'm the host of Accounting Insiders podcast and the publisher of Insightful Accountant and Tax Practice News, two online magazines serving the tax and accounting professions. Today, my guest is Ann Campbell, CPA, CIA, not the intelligence agency, but we're going to dive a little bit into what those definitions mean. She's a software trainer for Drake Software. So, Ann, welcome. Thanks for
Thank you.
in California. So, thanks for waking up early to hop on and record this with me. Certainly appreciate it. So we're talking about the Secure Act, Secure 2.0. But before we dive into that, just give us a little bit about. Again, I asked you before, but so you got CPA, Certified Public Accountant, right?
Yes.
CIA. You're not going to have
internal auditor, right?
Internal auditor. There we go. And that's funny. I mean, until this, I probably should have known that, but didn't. So I learned something. So that's good for me. And so Secure Act. Tell me a little bit. Actually, before we dive in, sorry, a little bit about your background. What? How did we end up on this call together to talk about Secure 2.0 Act?
Well, I've been in accounting for longer than I'm going to admit on a recorded line. I did get my CPA with Coopers and Lybrand. It was still the big eight. And then I went on to private industry, but I had done taxes and auditing with Coopers. So I kept doing taxes, for the last, however many years. And, but when I left a last job where I was the CFO, and it was at the point in my life where I thought, well, maybe I want to try something a little different. I've always loved taxes. I've always liked teaching, and found Drake Software. I've been using Drake Software for 11 years at that point, and it's a great product. So just started training software with them. And of course, I still have my own small practice that I continue to keep my feet wet, so to speak.
Okay, yeah, and so that's great. I mean, so it's great you have the history with Drake as a user, because you can bring that user perspective to Drake, right? And then the ongoing training. Certainly, it's probably true in a lot of markets, but I think in our space in tax and accounting, it's very true that people really like learning from their peers, right? Because I mean, you've sat in their seat, so you can go, yeah, I had 28 clients who all did the same thing every single time, even though I told them not to do it, and everybody in the room will go, yeah, I have those clients too. So that's invaluable, right? Being able to make the connection as a trainer.
The practical experience. And I think our Drake customers appreciate that, because like you said, they have, questions all the time. They got this, everybody has the same types of clients, the ones who don't turn in their mileage logs, the ones who don't want you to understand that cash is still taxable, that kind of thing. Yeah.
Right. So Secure Act 2.0. I did have to ask, was there a 1.0?
Yes, there was.
So before we dive deep into 2.0, what was, just nutshell, kind of what was Secure Act 1.0, and when was that?
I believe that was 2019.
Okay.
Yes, it was December 19th, 2019. And basically, the main thing I remember from it is they made it the RMD age 72 instead of 70 and a half. They changed the inherited IRA rules. That was, instead of letting it be over the lifetime of the beneficiary, now it became 10 years. That was a huge change for tax planning for a lot of people. And as a side note, what I do with a lot of my clients, again, I probably just like a lot of people out there, we have a lot of older clients who have lots of money in their 401ks and their IRAs. I started talking to them about perhaps splitting up the beneficiaries, especially if the surviving spouse wasn't going to need the money, because that 10 years, if your child inherits that money and they have 10 years to take it out and they're 55, that's probably peak earning years for them. So, things like that. There was a lot of planning that all of a sudden had to be redone. The other thing that the original Secure Act did was to make many more part-time workers eligible. So that was a big deal too.
Okay. And so now we wind the clock forward. You said that was 2019. So now we're in 2023. And when did Secure Act 2.0, when was that enacted?
December 29th, 2022. So just
Uh,
3 years later. They do a lot of stuff in December, as we realize as tax preparers. So it
But at
makes
least that was in December, not in April, right?
yeah, and at least it didn't really, this particular one, Secure Act 2.0, didn't really affect 2022 taxes. That's the part that always gets us as preparers, is that, this retroactive stuff, that it makes it very, very difficult to adequately plan for your clients. So, but yes, and they were quote unquote working in December. Yes. So here we go. So yeah, it was assigned in December 29th, 2022. And if there's three major things on that. It was supposed to improve taxpayers' ability to save by expanding retirement plan coverage. It was helping taxpayers keep more of their retirement income. And it was the one I like the most probably is reducing the retirement plan penalties and making the rules easier to understand. And all the changes are staggered. Like I said, they weren't retro, thank goodness. But some of the changes did actually start in 2023.
Okay. So would impact this year's tax return?
2023's, yes.
2023 tax return. Okay.
Yeah.
Okay. And so you kind of laid out kind of three key things there. The first one, I can't remember exactly what you said, but you said supposed to
expand retirement plan coverage. Yes.
Yeah.
Lots of things in this. And if we haven't already made it clear to the viewers, this is very, very, very high level. I picked the things that I thought would be most appropriate for tax preparers and maybe small business owners. There's a lot in this Secure Act. You need to probably talk to a retirement plan specialist to make sure you get all the things that are going to do. But let's go ahead and talk about some of the initial things that we talked about. Expanding retirement plan coverage. So there is one of the nicest things for small businesses is there's now a tax credit for 50 or fewer employees that create pension plans. So in some states, California is one of them, and I understand there's a lot more coming along the pipeline. Some states require businesses to have retirement plans. California's is almost all the way down to 5 or fewer employees, if I remember correctly. But if you are a small business, a lot of them didn't have any retirement plan. So now they're required to. And again, this is California, but I know there's other states coming along. But the IRS is making it easy to set up the plans because they might cost a couple grand or whatever. And instead of just having an expense, you can actually take a tax credit. And as we all know, the tax credits are much more valuable than the actual deduction. They also, new 401k and 403b plans, and 403b are usually for the nonprofits and the governments. They will have to include automatic enrollment and automatic escalation. This has been tried for years and years and years, and a lot of plans haven't written this in, but now it's going to be required for the new plans. And of course, the government hopes that you, as a business, you go ahead and when you rewrite your rules to be compliant with Secure 2.0, that you do that.
And what is escalation? What does that mean?
Escalation means that, let's say you tell automatic enrollment at 4%, and then you're going to escalate it, usually 1% a year. So like the next year they'll be at 5%, the next year after that they'll be 6%. And it would be automatic rather than they have to opt in.
Gotcha.
And again, people have been really afraid to do this automatic enrollment, but I believe a lot of the studies say that usually people don't even notice it, especially at 4%, whatever the minimal amount is. Now the escalation, they may or may not, depends on if they're actually getting raises or not. They may or may not notice it. But yeah. So another thing, long-term part-time workers are going to be more and more covered. If we remember our old rules, usually you could say anybody who worked less than 20 hours or whatever wasn't covered, wasn't allowed to participate. What I have found in my practice is that I've got a lot of people who are on Social Security, but they want to work a part-time job. and
Mhm.
they do it more for social or to get out of the house. They don't really need the money, so they want to put money into their retirement plans, and this is going to allow them to do that more easily.
Do you
Uh,
know if like with the auto enrollment and these part-time employees, is it set up or structured so that the plans are available, but there's not a mandatory match? Or
I believe that they're still going to have to do the match because
okay,
that's like, I don't think there's any exception for
okay,
part-timers. And again, the whole idea, Congress wants people to save money because we all know you're not meant to live on Social Security, and there are pretty much no more pensions.
right,
So what do? You got to make people save.
right, okay. Then so how do the rule changes kind of ensure that retirees, keep more of that plan income? Is there anything that's impacting either when they take it out or impacting the distribution side of it?
Yeah, basically, you've got uh, one deferring the RMDs to 75, which is one of the things we didn't mention yet. Eventually, you won't have to take any money out until you're 75. And that's a good and bad thing, because if they let that grow tax deferred longer, hopefully they'll have more money. But then again, their RMDs are going to be higher, depending on their balance. But as far as uh, special things that people are allowed to do, and this is something that not all plans have put in, but there's something called life annuities, and those allow basically you to annuitize some of your retirement plan. And there's so many special rules with that. I'm not an actuary or a plan specialist, but if you work with a good provider for your 401k, this is something that is actually a great idea because people are always worried about running out of income, that they're going to run out of their money. And if you allow them to annuitize some of that within their IRA or within their 401k, that's going to give them a feeling of comfort. And it also had some, Secure Act 2.0 had some changes to the rules about allowing deferments of annuity dates and things like that. It's a really high topic level, but it's something that I have actually worked with two small businesses to get them to change their plan because people just go, I want to make sure I never run out of money. So it's a great option.
And is that part of kind of we had talked before just about the penalty reductions and rules simplifications? I think simplification, yeah, I'm not sure if we've touched much on the penalty reductions.
Yeah,
What can you share about that?
yeah, penalty reductions. Okay, because you may or may not be aware that if you do not start taking your RMDs, there was a 50% penalty of whatever you didn't take. Well, I don't know about you, but in my tax practice, I've had two. I think one lady was 80, and she had never taken an RMD,
Oh,
and she goes, "Well, I don't need the money." Well, that's great, but the IRS says you have to take it. And fortunately for us, generally the IRS, if you fix an error as quickly as you can,
mhm.
they have been exceedingly generous in forgiving penalties, but I would not necessarily expect that to continue.
Yeah,
With this particular client I mentioned, we immediately, I mean, literally that day, I made her sit down and call her plan provider, and we said, okay, this is how much she has to take, and she has to do it now. And then we put in a disclosure on her tax return, and they did waive the penalty, it was a substantial amount of money.
yeah,
And of course, then we got her on a regular schedule. But what Secure 2.0 is going to do is, first of all, they're dropping the 50% to 25, which is much more palatable. But they will also, if you correct the deficiency timely, like I was just explaining that process, they will drop that down to 10%.
hmm,
But what I don't expect them to do is to forgive it anymore.
right.
So it's something that when I've got clients at a certain age, I make sure that I talk to them about the RMDs, because they definitely need to take that. The other thing it did, there are no penalties. Again, we're all used to, if you're under 59 and a half and you take the money out, you're going to have penalties for that. Like usually it's 10% or whatever. But now they've added a clause if you're terminally ill, and you will not be subject to penalties for that, which is nice.
Right.
And
Go
ahead.
go ahead. No, you've got the info. So yeah.
Well, the other topic on this section was simplification. So we've got lots of rules when it comes to these retirement plans, and the IRS knows that they're just crazy. So they've said, okay, can we simplify it? Because people, I don't think, intentionally mess up. They really do mean to do things correctly, but everything's so confusing. A perfect example is this 10-year rule. Up until about January, when the IRS issued another regulation, nobody thought that there was RMDs required on a beneficiary's IRA. They just said, okay, you have to take it out by the 10th year. Well, the IRS said, no, you're supposed to still take RMDs during this 10-year period. But they already forgave the, for 21 and 22, they said, if you didn't take them, we're just going to ignore it. But that was a real surprise. And it wasn't like people weren't trying to do the right thing. They just were surprised. So they've tried to simplify the rules. One of them is a hardship withdrawal. And if you understand what those are, you're not supposed to touch your money before 59 and a half. And a lot of 401ks don't let you take money out if you're in service. But if, let's say, you really need the money for a medical emergency or something like that, you used to have to give paperwork to your plan administrator and do all this other stuff. Now they allow self-certification. With that said, I would still expect to have, if you do get audited, you'd want to have the backup, that it really was something like a medical emergency or something. Right. You've got things for sole proprietors. If they establish a 401k plan, and they do it, like, I think if I remember correctly, and don't quote me, but if you do it in the beginning of the year, and then you could actually retro back to the prior tax year to do some contributions and things, and that might be valuable, especially if you need a deduction. There was a recent court case, for example, on prohibited transactions, and this is another big one. If you do a prohibited transaction in your IRA, let's say you bought the wrong kind of gold coins, if you have a self-directed IRA, or you bought real estate that you lived in yourself, or things like that. And a lot of this happens with self-directed IRAs. It used to be that you have now disqualified all of your IRAs. And that's a huge deal, because basically it acts like you took all your money out, and then you're subject to maybe early withdrawal penalties and some other things. What the court case did was it said it will only apply to the IRA where the prohibited transaction was made. So that's a win for some people who have several different sets of money. Then they're not jeopardizing their entire retirement plans. One last one that was really nice. I don't know if it's really simplification, but the federally declared disaster areas, we're all familiar with that now, because if you want to have a casualty loss, for example, your only way you're going to get that is if it's a federally declared disaster area. Okay. So what this thing allows you to do, this rule, is you can take up to $22,000, and there's no penalty. You can actually recognize that $22,000 over 3 years. And you also have the opportunity to repay it up to the 3rd year, and then it would just be wiped out. And if that sounds familiar, it should, because with the COVID, I think it was 2020 when they allowed you to take up $100,000, and then you could repay it back in 3 years, and there was no harm, no foul. It's basically the same process. Okay. So that's good.
So is and this may be out of the scope of this conversation, but do you know what the reasoning is behind the RMD?
Well, besides the fact that Congress wants their money,
Right.
for that, basically that's the reason. They
Yeah.
don't want this to be a one of the reasons they changed the 10-year rule too was they don't want it to be legacy wealth building for generations and generations. And the honest to goodness truth is nobody can keep track of it anyway. So I think they realized that it was almost impossible to track an inherited IRA. But the RMDs, you know, especially the pre-tax money, you've been deferring tax for maybe decades,
Hmm.
and they want people to start paying that back when they get to retirement age. But they also have deferred the RMD age. Now it went from 70 and a half to 72. And
Yeah.
then I believe in 2032, it's going to be 75.
Okay.
So you can push it off longer, but you still need to take it. Now, the caveat there is when you do take the money, if you're able to defer it, you're going to have larger RMDs. And if I can say one thing to people out there, the tax preparers, you need to talk to your clients and say, how much money do you have in your
Hmm.
IRAs? And have you ever looked at how much you're going to have to take out? Um, People think I'm being nosy when I say that, but when I explained to them why, I said we have to do some tax planning for you. And I've got clients with 3 million, 4 million in their IRAs, their 401ks. That's quite a chunk of money to
Yeah.
take out. That could be a $300,000 RMD. So when you tell them that and they're 62, then we do some planning
Right.
with, hey, defer Social Security and start taking your IRA money. And then you can get that down. Or maybe they should do one of those annuity contracts we talked about. Those calculations can reduce the RMD. And again, that's beyond the scope of our podcast, but there's a lot of planning you can do with people, especially with their hefty RMDs. But that's a good problem to have, right?
Right.
Um, the main thing I think of Secure Act 2.0 is to get people to save, because of course we have a lot of people who don't.
Right, sure. And I think too, and I think for our primary audience again, which is tax and accounting professionals, it brings up, and this may be one of the questions that we have on here, I can't recall, but just the advisory opportunity, right? And we were talking kind of before the call, the trainers, talking heads, whatever you want to call them, at shows and conferences, for the past 10 years have been saying, hey, it's about advisory, it's about advisory, it's about advisory. And I don't think it can be said enough because the tax and accounting professionals are certainly the closest to the money, the closest to the small business owner who needs advice. And most small business owners, we're a small business. Most small business owners are heads down doing their thing, and aren't necessarily thinking about the tax implications of X, Y, or Z, or oh gosh, I've got this R&D I have to take. How's that going to impact my planning or my future?
Mhm.
So I want to stress just while it's 2.0, who knows, maybe we have 3.0 in a year and a half, but it's it is an opportunity. It's an opportunity for tax and or accounting professionals to sit down with their clients and go, hey, you may have heard about this.
Mhm.
That's what it means to you.
Right.
And small business owner, you got another 15 years in your business. Here's how this could impact you. Or if you're in California or one of these states that will be mandating retirement plans, either currently or in the near future, that needs planning.
Mhm.
And it's, in my opinion, it's the tax and accounting professional's job to bring that to the small business owner, to the business owner, and say, one, it's an opportunity, but two, it's an obligation. And it's a legal obligation and it's going to have tax consequences. So the community needs to be advising around this. And
Mhm.
I don't my accountant hasn't mentioned it yet. So
Yeah, and that's a shame because I agree with you that sometimes with my small business clients, I'm the I'm the only one they ever talk to about anything that
right.
is planning or financial, and it's basically because I sit them down and make them do it.
Yep.
But I'm really attacking my I shouldn't say attacking. I am really making my older tax clients sit down. There is a huge amount of money in retirement plans, and I
Right.
don't think people really understand the implications of that. But the other thing is they have time in their, even in their early 60s, to plan to reduce that tax liability. With my younger clients, I tell them to do Roths. I said, just do a Roth. You know, I'd like to think that they're not going to change the rules on the non-taxability of Roths, but a young person who is making, $15 an hour,
Right.
let them do a Roth. Let them do a Roth. Oh, and that was the other thing. I think I don't think we mentioned it. I believe the retirement savers credit, which is on Form 8880, if I remember correctly, that will change, I believe, to be a refundable credit. And if that would be a huge win, because a lot of the younger people don't have any tax liability, or not a big one. But
Right.
if they can get a credit back, hey, again, we're talking, it's like when somebody doesn't want to do a 401k. I said, you put in $1 and your company puts in 50 cents. Where else are you going to get that return? It's
Exactly.
the same thing with this retirement savers credit, and to make sure that if they're the lower income younger people, sometimes I'll work with a client. I do their child's return. They're a young adult. I work with the parents and I say, put some money in a Roth IRA for them, and then we'll get the credit. And they understand that a little bit better.
Okay. And that's for the individual that you
Yes,
said 8880, right? So,
but see, if you put money in a 401k, it still counts for that. So
okay.
that's great, which is what all this stuff is about.
Right. Okay. Fantastic. So, something about emergency savings accounts. I don't think we touched on that. What's that all about?
No, we didn't. And that's another big win. Again, this is something that has to be written into the plan, but we will, the Secure 2.0 will allow emergency savings accounts. And I wish I had more details about how to actually implement this, but my understanding is that they will allow you to put aside um, pre-tax money. And again, the regulations aren't final, but through your employer. And then if you need that money, you can just take it out. There's no, there, there's nothing, there's nothing to explain. But how many people don't have even $1,000 to cover a car repair bill or
Right.
something like that? And we all know that if you don't see it, you're probably not going to spend it. So that was a real win as well, but it has to be written into the plan. So that's where you talk to your small business clients and tell them to talk to a good provider and get this stuff up. I suspect a lot of plans will be rewritten this year to cover things like this. One of the other ones was student loan payments. And again, it has to be written in the plan, but it will, Secure 2.0 will allow student loan payments to be treated as retirement contributions. So, if, let's say, the student puts in, or the ex-student puts in $1,000 of their loan payments, the company can say, okay, that's as if you put $1,000 into the 401k, and then we'll just match it.
Really?
Like, that's a win. Okay, how many people don't save because they're paying off their student loans?
Right.
They can't afford it. They can't afford that extra whatever amount of money. So that's another big win. But again, the plans have to be amended to allow for this. And it's not real clear, again, on how all this actual, details are going to work out. So there's a look in the next couple of months, especially for regulations and guidelines from the IRS.
Okay. One more before we wrap up, because I want to be respectful of your time. That is the around 401k plans. When we were talking prior to going live, I had mentioned we use a company called 401go, and there's others like Guideline 401k, I think is the name of it, and a couple of others. Are you seeing, and these are, I think their go-to-market strategy, right, is, hey, we're low cost, we're using a lot more technology to drive the process and to engage with the business owners, and we've seen it be successful for us. Are you seeing more companies lean towards more of your clients, small business owners, lean towards these types of plans or these types of companies for their
Um,
401k plans?
in California, there's a government option, which a lot of the small businesses just did because they weren't getting any, like they didn't want to put thousands of dollars into setting up a plan.
Okay.
Um, I so I know that there's a lot of companies out here who will help you set up a plan and do it, quote unquote, at a reasonable cost. Um, you know, Definitely get help. I mean, if you're going to set up a 401k plan, you need to get it done correctly.
Right.
And be careful of the fiduciary responsibility that you're putting on yourself as if you're the trustee. Um, but it's just like do it yourself divorce. I mean, maybe that's not the wisest thing.
Right.
You do want to get advice. But here's the other thing a provider can do for you if they're a good provider is they know all the rules. They go, hey, you're a small business owner. You own 100% of the company. Yes, you have a few employees, but they can do like a safe harbor, so you can put in more money yourself. They can work in all these little special things, and you're going to be enticing people to work for you if you offer these kind of plans.
Yeah.
The only other thing I'd mention here is when you have a sole proprietor, don't forget that you can do a solo 401k, and those are much more valuable than just doing a simple IRA or a regular IRA,
Mhm.
even a SEP IRA. For solo 401k plans give you a lot more options than say a SEP IRA or things. And again, way beyond the scope of this
Yeah.
podcast, but I've seen some incredibly creative investment opportunities in a solo 401k, which includes like life insurance and some other things, which
Mhm.
blow my mind how creative these people can be, but they can't do it in anything but a 401k.
Right. Okay. Well, so I think that about wraps it up. Unless you've got something that a parting word of wisdom, other than so I shouldn't do my own divorce papers,
Yeah.
and I probably shouldn't do my own appendectomy or anything like that either.
Yeah.
Right? No self surgery and no self 401k plans. Use a professional.
Yeah,
Uh,
use a professional. I did have one other thing that I forgot to mention, catch-up contributions. And I don't know if I think it starts in 2024.
okay.
If you're 60, 61, 62, or 63. There's, we all have these catch-up contributions, 55 or over, or 50 or over, but there's going to be special extra rules for the people in the 60 to 63 year range to supercharge those contributions. So that's something to look out for too.
Yeah. And I'll wrap it up just with something I said a few minutes ago. And that was, again, primary audience for us is the tax and accounting professional. And so, the Secure Act 2.0 is just from the little bit that you've shared, there are just massive advisory opportunities around just that single topic. And then we've also, talked about other, this kind of burgeoning lower cost 401k plan options that are out there that I really think, again, as a small business owner, we've seen the value of bringing one of these on board. And it's inexpensive and it's not self-service, but it's guided very well. And it's for us, it's very affordable. And so there's great plan options out there. And I think as the trusted advisor, tax and accounting professionals are in a great position to really help small businesses to better plan for the owners for their own retirement, right? But also for the structure of their company that's in the best welfare for their employees.
Correct.
And for some of you, it's mandated or will be in the very short term,
Mm-hmm.
very near future. But for the balance of the country, it's a really, really good idea. I don't know if that's the right way to say it. But
for the other people.
yes, yeah.
Yeah. And for our Drake customers, they can rest assured that we're already working on implementing that into the 2023 software and beyond.
Great. All right. Well, so will you go to any shows with Drake? Do you, will you do
Oh yeah, we do.
IRS forms or anything like that? I know they go
Yeah,
everywhere.
yeah, we do. I travel with the update schools. Obviously, we have annual update schools. We
Yep.
have local training. I'm actually uh, out at some of the shows too.
Okay. All right. Well, maybe we'll bump into you at a show face to face. So,
Sounds
well, thank you
great.
so much for taking some time and sharing your knowledge on Secure Act 2.0 and a little bit on the 1.0.
Yeah,
Right.
and thank you for having me. Thank you.
Absolutely. Thank you. Bye bye.